Hello and welcome to Millionaire Mindset on Mondays. I'm Steve McClellan, the financial engineer, and every Monday we go live to give you advice, guidance, and tips on how to grow, control, and keep what you build instead of giving away to taxes, fees, losses, and the unknown. And today we're going to dive deep into the truth about the infinite banking concept. Now, while I'm going to be sharing some great financial advice here, every situation is different. Seek individual professional financial advice before putting a penny into these strategies. And the stuff that we're going to talk about may not necessarily reflect the same opinions as the good people at Design Your Future Financial Services and IB Canada Group. Let's go. Financial independence. What is it really?
Somehow, we've come to believe that financial independence is a gift reserved for the chosen few, for the lucky ones. You can forget that. The truth is, financial independence is for all of us. We are all capable of it. All of us. And this isn't about lowering expectations. It's about raising them for every last one of us. Financial independence is a scary thing until it isn't. Sometimes it's about overcoming insurmountable adversity. Sometimes it's just plain fun. Is financial independence for you? What do you think?
If financial independence doesn't come knocking on your door, maybe, just maybe, you should knock on its door. Welcome to Millionaire Mindset on Mondays. I'm Steve McClellan, the financial engineer, and every Monday we go live to help you grow, control, and keep what you build instead of giving away to taxes, fees, losses, and the unknown by giving expert, unbiased, and independent advice. And that's exactly what we're going to do here today. We're going to dive deep into the truth about the infinite banking concept. When this presentation is all said and done, hopefully it'll be between 25 to 30 minutes, you will know what the infinite banking concept is, and you will realize if it's for you or if it is not. Now let me save you some time. If you're struggling to put food on the table, the infinite banking concept is not for you. You need to put food on the table. But if you're making average or above average income or have a nest egg that you want to protect, the infinite banking concept could just be for you. I'm going to be sharing lots of information here today, folks. Some of it you may have heard, but I can almost guarantee you the majority you have not. You will not get this type of advice and guidance at the banks or from your traditional advisor. And it's going to be useful information. That's my promise to you. You're going to actually want to use this information and share it with those that you care about, but you need to be present. We only retain about 10% of what we hear. That's why I added some cool visuals to help you retain more. Of course, take great notes. But if you really want to learn something, treat this like you're going to teach it to those that you care about, your colleagues, your family, your loved ones. You need to be present. So let's just turn off the phones for the next little bit and focus here. Just be present because there's going to be lots of great ideas coming your way. And if you're not here, you may just miss one of those life-changing ideas. So again, welcome and congrats. We're going to dive deep into the truth about the infinite banking concept. We're going to talk about the current situation, how we actually got here today. We're going to talk about the infinite banking concept, what it is, and then I'm going to give you a real life example. I'm actually going to use how I use the infinite banking concept and use a properly structured dividend-paying whole life policy, my very own policy, and I'll explain why we use a properly structured dividend-paying whole life policy. And at the end, you can ask away, ask any questions, and we will do our best to answer whatever comes up. All right, great questions lead to great answers. And one of the great questions out there is, if you are not aware of a problem, will you ever search for its solution? I'm going to ruin movies for you. 98% of movies follow kind of the same guidelines. There's a hero, the hero has a problem, a guy comes along and helps that hero, and they get to that happy ever ending. Now, this even happened in the movie The Matrix, where Neo was given the opportunity to take a red pill where he could discover what is actually going on, or he could take the blue pill and continue that state of ignorance, that bliss. I love going live here, folks. The blissful state of ignorance. Now, he knew something was not quite right, and I'm going to give you that same opportunity. You can take the red pill or the blue pill. If you take the blue pill, you want to take the blue pill, just close your eyes and plug your ears for the next 2 minutes, because we're going to give you the red pill right here, the cold, hard truth. If you look back in 1980, Michael Jackson just making it big. Radio stations played all different types of music, and for every dollar in, 80 cents was going out towards debt. Now, where do you think we are today? A lot has changed since 1980. Are we becoming better at saving or worse? Unfortunately, according to the stat, what this means is for every dollar coming in, $1.71 is going out. We are spending way much more than we are making. Way much more. Does that make sense? Again, going live is fun sometimes. And unfortunately, according to the Canadian Payroll Association, that debt is increasing for 38% of Canadians. 53% of Canadians are on the brink of insolvency, according to MNP. And this is not just a personal issue. This is actually a federal issue. Look at that number. Look at Canada's debt. I can't even say that number. It's so big. And what does that mean? To pay off the debt in 2021, every Canadian would have to owe $57,500. Now, do you think taxes are going to increase or decrease in the future? The government spending right here, this is the number one cause of inflation. And this isn't just happening in Canada. This has happened worldwide. Countries are in debt to their eyeballs. Companies are in debt to their eyeballs. And people are in debt to their eyeballs. And it's not just a debt issue. Look, this stat scares the crap out of me. According to the Canadian Payroll Association, the percentage of people who could not raise $2,000 in a month for an emergency is 34%. That's crazy. So who's this affecting? Who's underwater? It's not necessarily who you think. It's the hard workers. It's the professionals. It's those making more than $100,000 a year. And according to Benefits Canada, it's affecting 91% of Canadians. 91% of Canadians will never reach or maintain financial independence. Now, why do I share this with you? Well, it's to scare you a little bit. It's giving you the cold, hard truth. But it's also affecting our relationships. It's affecting our productivity at work. And it's affecting our mental health. Truth is, 100% of us have done something foolish or something stupid with our money at one time or another. The big difference between those that reach financial independence versus those that do not is those that reach financial independence learn from their mistakes and take the appropriate action. Big question I like to ask, why are we making the mistakes in the first place? A lot of professionals like to blame education or the lack of education. And maybe they have a point. Think about it. Where did you get your financial education? It's generally not taught in schools. If it is, please share with me where you got your financial education, and I will share it with others. But the majority of people will get their financial education from their parents. And where did their parents get their financial education? I know when I asked about money growing up, I was more or less told to be, shh, Steve, talking about money is rude. But even the financial guidance that your parents or grandparents used, do you think it still applies today? And the answer is no. And truth be told, lack of education is not really the problem anymore. Maybe 10, 15 years ago it was, but Now there's a thing called Google. So if you can Google if you want to become a better investor, if you want to become a better parent, or if you want to become a better leader. The problem is, where do we get the financial education, the financial advice today? Because there's so much of it. The majority of Canadians will go to the bank. And do you know where the bank make the majority of their profits from? Where did the bank make all their money from? And the answer, you're looking at it, if you're looking at this presentation right now, it's from debt. Credit card debt, lines of credit, mortgages. The majority of Canadians are taking financial guidance from an institution that wants you to be in debt. Now, I work with great people. I know lots of great people that work at banks. They're fantastic people, but they have to serve the institution. Imagine if they did. Imagine if they did what was best for their clients day in, day out. What would happen to them? How long would they last at their job? Not too long. Now, what about the traditional financial advisor that says, put 10% away and then live off that when you retire? Let's look into that. One of the things that's missing from the wealth equation is the fact that money is not bar charts, graphs, and numbers. It is emotion, and it is highly emotional. It doesn't matter who you are. The news, what is going on, the markets will affect you in the way you manage your money. There are very few people that are in the stock picking market Hall of Fame. Did I say that right? Stock picking Hall of Fame. Financial advisors, no matter how great they are, tend to be very biased, and they are still very emotional. And let me share with you one of the dirty little secrets in the financial industry. What is often reported is the average returns. Not the actual returns, but the average returns. So let me share with you exactly what I mean. So imagine you had $100,000 and you put it into the Apple stock, right? You bought a bunch of Apple stock, and the next year it went up 100%. So that 100,000 turned into 200,000. Pretty good, right? Awesome. But the next year it went down 50%. So 50% of 200,000 is back down to 100,000. So what is your actual return after 2 years? It's zero. What's your actual rate of return? Again, it's zero. But what's your average rate of return? Well, it's 100 minus 50 divided by 2. It's 25%. A big difference between actual and average. And Darren Mitchell, in his book, Be the Bank, really dives into this. He shows that if you took $1 million, like we're told to, and live off that, what would happen? Now, he said if you got the average rate of returns, that $1 million after 20 years would turn into $14 million. I can't remember exactly, but it was a lot of money. But then he took it a step further and showed what would actually happen if you put that money where it got an average rate of return of 14%. So a lot of times the average rate of returns are talked about 14, 12, 10, 6, really depending on where you put it in and where you put it out. He shows what would actually happen if you put that $1 million in 1970 and had it tied to the market. You can see this graph. That $1 million, if you were taking 100,000 out and it was tied to the market, that $1 million is gone in 13 years. Huge difference between average and actual, folks. And I know history doesn't repeat itself, but it often rhymes. The industry seems to be focusing on the top 10%, and it also seems to be pushing save 10% and eventually live off that, where we all know it was the bottom of the iceberg that sunk the Titanic, and this is what is sinking the majority of people's wealth. If you want to become financially independent, you need to stop taking average advice for average people. Another thing missing from the wealth equation is Parkinson's law, also known as the vicious cycle of money. The more money you make, the more you're going to spend, and you're going to spend way more than you'll ever invest. And also, the Willie Sutton's Law, never talked about. Willie Sutton was a bank robber down in the States, and when he was finally caught, he was asked, "Willie, why do you rob banks?" And he simply answered, "Because that is where the money is at." Now, when you get your money mindset right and you'll realize making money is not the difficult part, it's the keeping it, because so many things are trying to take your money. And the two biggest thieves, the two biggest villains are taxes and debt. Taxes and debt are the biggest villains for you to reach that happy ending in this movie we call life and stopping you becoming financially independent. Do you have a strategy to defeat these nasty villains? And that leads us to another great question. What is the infinite banking concept? Well, according to the Nelson Nash Institute, the infinite banking concept, or IBC, is the process by which one becomes their own banker as taught by the late Nelson Nash. Now you can see this gentleman. He was a fine gentleman. He's the father of the infinite banking concept, and they have started the Nelson Nash Institute, where they actually train people to become infinite banking concepts authorized practitioners. Now there's only 50 in Canada. I am one of them. And I'm also a member of the IB Canada group, where we are a group of independent advisors that do what is best for our clients. That's the definition of the infinite banking concept. I look at it as a way to recapture your interest that you normally would have given to a lender. You're actually able to capture that compound growth that you normally would have given away. And one of the ways I differ from the majority, even those that are authorized practitioners, is people that love the infinite banking concept. They really treat it as all or nothing, to put all your eggs in one basket. Now, if you were going to put all your eggs in one basket, this would be the basket I would recommend, the whole life or becoming your own bank. But I am a big fan of being diversified. Now, diversification doesn't mean owning a balanced fund or a bunch of stocks or a bunch of mutual funds. That's not diversified. That's just putting your money in the bank. That's what the majority of advisors or financial professionals or financial whatevers will tell you. But a truly diversified portfolio consists of your business or your employment, real estate, of course, investing and saving. That's what gets all the news and the emotions. It's like a roller coaster. Living benefits, especially for business owners, so you have money coming in if anything were to happen to you. I'm the expert when it comes to whole life or becoming your own bank. And of course, there's the alternatives such as cryptocurrency, there's precious metals, there's other currencies, angel investing, the list goes on. Okay, so if I was going to ask you, out of this diversified portfolio, where are you going to make the majority of your money? Where are you going to create the most wealth? And if you're watching these Millionaire Mindset on Mondays, I hope you're screaming out, "It's me, it's me." Yes, it's you. You are your major key to success. You are your number one asset. And when you realize this, you got to start acting like it. Now, a lot of people will answer that question. They'll say, "Steve, is it the whole life?" And that's because they think I'm trying to sell them a whole life policy. No, you are your number one asset. And when you can get really focused and great at what you do, your net worth is just going to go up. What's nice about the become your own bank or the whole life, this acts like an asset. It's not one or the other. It actually complements all these other forms of wealth creation. So it's not this or that, it's and this. I hope that makes sense. So the infinite banking concept, let's describe it here. So let's use buying a vehicle as an example. So the majority of Canadians out there will go and borrow for their car. Let's say it's a $40,000 car. They borrow, the banks are nice enough to give them $40,000, and eventually they pay the banks back and they pay interest there, right? So see that? $40,000 over time, pay the bank back. But is that the only car you'll get? If you're like most Canadians, no, you'll continue to get car after car after car after car. This repeats itself. So the bank was nice enough to give you the money for the first car, but where did the bank get the money for the second, third, fourth, fifth car? Think about it. They got it from you. The banks are making tremendous amount of money from this rinse and repeat, and this is the power of you. Instead of relying on the banks, you can become your own bank. Now, what about the saver? Now, I was a saver. I saved up for my first car. It was a 2012 F-150. I did all the math and spreadsheets, but this was before I realized the opportunity cost that I was losing. So I saved up my money. I bought my truck knowing that if I did the math, as long as I bought another vehicle, paying cash was the best process before I knew about the infinite banking concept. And that's exactly what I did. But look at this. Look where the saver and the debtor end up. They end up at the exact same spot. And that's the power of the infinite banking concept. Look at this. This is acting like a saver at first, and then borrowing against yourself. So that initial $40,000 that would have left you, that would have disappeared when you gave it to the dealership, you would have got a car, but your money would have left you. But now you're borrowing against yourself, and that $40,000 is getting uninterrupted compound growth very tax efficiently, and you can see the huge difference that makes down the road. Compare this to the saver, the debtor, where you can become the banker. Huge difference. So one of the things we use to become your own bank is a properly structured dividend-paying whole life policy. Now, why do we use a properly structured whole life policy instead of a universal life policy or an RSP or tax-free savings account or real estate? There's lots of reasons, but the number one reason is the value of your whole life policy never goes down, where all the other ones do have an opportunity to go down. So this is my very own properly structured dividend-paying whole life policy. And with a whole life policy, one of the negatives about this is you do have to be approved. So it is an insurance product. You do have to apply for it. When this is set up properly, there are two portions. There's the insurance portion, and then there's a portion that you can use while you're living. I have this set up here where I have a $100,000 policy for whole life for the rest of my life at a premium of $1,979. I'm not going to spend too much time on the numbers. That is for life, and then I added a $1 million term rider for 10 years that comes at an annual premium of $841.92. Now, if you're looking at these two differences, look, why is $100,000 whole life almost double than the 1 million 10-year term rider? Why do you think that is? Well, the answer is the insurance company is pretty sure I'm not going to die in the next 10 years. But I hate to be the bearer of bad news. We are all going to die sometime. All right. This $1 million term rider, what this does, this gives us the opportunity to put $44,194 into the deposit option. This is the option that gets the dividend. Now, the dividend is not guaranteed, but it's the closest thing to a guarantee I've ever seen. It's vested, meaning it never goes down, and it gets that true compound growth very tax efficiently. So this is the portion you can use while you're living. So let's look at what that actually means. So lots of numbers, I know, and I don't even have my glasses on, but let's go through this right quick. So what this means, over the first year, you have the ability to put the minimum amount in, which is the cost of insurance, $2,821. And after 10 years, that decreases to $1,979 for the rest of your life until the age of 91. So no surprises, no ups and downs. It is what it is, giving you the ability to put a maximum of $47,016. So if you put the maximum in, at the end of the first year, your cash value is $43,381, and you have a death benefit of $1.25 million. Now, if you're looking at this and you're saying, hey, I put in $47,000, you're telling me the cash value is $43,000, that's not a great rate of return. And you're right, it's not a great rate of return unless you die. Unless you die, then it's a great rate of return, but you don't want to die. We don't want you to die. We want you to use this while you're living. Why do you think this is lower than what you put in the first year? Well, the answer is the cost of insurance has come out, commissions have come out, and the cost of underwriting. So this really breaks even after year 4 here through compound growth. If it gets the current dividend, which, listen, the current dividend, I have to let you know, is not guaranteed, but it's the closest thing I've ever seen. And this continues to grow and to grow and to grow. So let's look at the magical age of 65, where everybody thinks they gotta retire, and we know most of the people won't. But at 65, you have $1.6 million in the cash value. This is the ability, this is the portion you can use while you're living. Now, you have access to this 3 different ways. You can borrow up to 90% of it through what's called a policy loan. That's a simple autograph. The interest on that policy loan is usually prime plus 2, never goes over 8%. And no, you do not collect the interest from that policy loan. That does go to the insurance company. I know that's asked quite a bit, but you still get that true compound growth on this original amount, that $1.6 million. You also have the ability to go to a bank and borrow 100% of it. This takes a little more work. They look at your net worth. They see if you're approved or not. And then, of course, you can take it out directly, which I do not recommend, because you will pay capital gains on it. It'll be treated like a conventional investment, and it interrupts that compound growth. Let's compare this to a conventional, well, let's compare it to an RSP. So say if you had that $1.6 million in there and you needed access to it right away, how much could you actually get? Well, if you live in my little province, you're going to be taxed at 51%. So roughly 50% you can keep, $800,000 you can keep, where $800,000 goes to the government. So it's not necessarily what you have, it's what you get to keep. This is almost like a tax-free savings account. The problem with a tax-free savings account is you can only put so much in there every year, and it has the ability to go up and down, where again, this just continues to grow very tax efficiently and gets that true compound growth. All right, don't need to go through these numbers. And let's see if my clicker will work. So let's compare this to what other advisors work. So let me be crystal clear here, folks. Only 10% of the financial professionals out there even talk about whole life policies, and then only 10% design them the way I just showed you. Even this policy right here is a pretty good policy. What I showed you before is great for the infinite banking concept. This one is good because this still has a deposit option. A lot of advisors out there don't even add a deposit option. They just sell it as a complete whole life package. And there's 2 main reasons why they do this. Do you know why they do that? Well, number one, they're not properly trained. This is not complicated, folks, but they didn't spend the time to actually do what is best for their clients. And the second reason is commissions are generally based on the amount of insurance. So the more insurance, the higher the commissions. All right, going on a little bit of a tangent there. You can see my blood boils a little bit because there is a right way to do this, a better way to do this. Again, the policy I'm showing you here right now, this is a good policy. There is a $34,900 deposit option. The cost of insurance is quite a bit higher, though. It's $12,000, giving you that same initial premium of $47,016. What does that look like? Well, let's compare them side by side. Look, the cost of insurance for the more efficient one for the infinite banking concept is at $2,800. and goes down to 1,700, I know life's going to happen. Maybe, just maybe, income's going to stop coming in. Life's going to throw some wrenches at you. You should be able to afford the 2,800. Where affording the 12,000, that may be an issue. The more efficient policy over there breaks even after year 4, or between year 3 and year 4, where this breaks even between year 3 and year. I love going live. This one breaks even between year 9 and year 10. And if you look at the cash values at age 65, this is roughly 1.48 million, where this is 1.6 million, almost $200,000 in the difference. Where the other policy kicks ass is this continues to grow. There's a bunch of ways to do this, but this continues to grow. If you reach the age of 100, you have a death benefit of over $6 million. So if that's what's important to you, what's nice being independent, we can do this the way you want it. If leaving that big legacy and you're sure you're going to live $200, then this might be the better option for you. Otherwise, if you want to use it while you're living, the more efficient policy is generally what I would recommend. But it's nice we have the ability to do either or. I use this myself. So we are doing some construction in our backyard. We're putting a pool and a turf field in there. I can't wait for this to be finished. But we borrowed $50,000 from my own policy to make this happen. Now that $50,000 will continue to get interest, and we can pay that loan back whenever we want and however we want. Pretty powerful stuff. Look, we all have a destination that we want to get to. The majority of people are advised to put the money in the market, which is a bit of a roller coaster. When do you think most people buy? And when do you think most people sell? And then when it's all said and done, when you reach that destination and you start taking that money out, that money then goes away. The nice thing about the infinite banking concept is even after you reach that destination, it can continue to grow tax efficiently, leaving a huge legacy for whatever you want. A charity, your loved ones, it's totally up to you. You have access to your money anytime you need it too. This picture really encompasses the benefits and the negatives of the infinite banking concept. This is true compound growth. Albert Einstein called compound growth the 8th wonder of the world, and he popularized the rule of 72. So the rule of 72 is you take the interest that you receive, divide in 72, and that's how many years it takes for your money to double. So that's one of the negative things about the infinite banking concept. It can take up to 10 to 12 years for your initial investment to double. It feels painful, it's slow, it's boring. A lot of my clients will ask, am I doing the right thing? Because they don't see the growth right away. But those that have been involved in this strategy for a long time come back and say, oh, I wish I put more money into this, right? It's that true compound growth that takes some time, boring at first, but very exciting near the end. The positives about the infinite banking concept: it grows tax efficiently. It's creditor proof. So if our prime ministers ever decide to declare the emergency act again, the money is protected. If you're going through hard times, creditors can't get it. You have access to it whenever you need it. No begging. Just a simple autograph. You can get your money whenever you want. And it allows you to buy other things, whatever they are. I gave an example of buying a car, but it can be a business, it can be an investment, it can be properties, it can be anything. Some of the negative things about the infinite banking concept: it is an insurance product, so you do have to apply for it. It does take some time to get that true compound growth. You do not collect the interest, I guess, from the policy loans or the bank loans. And it doesn't decrease your income tax, but it does. It does decrease the taxes that you paid. I think I showed you a great example, especially if you compare this to an RSP. All right, folks, I hope that answers any and every question that you may have had about the infinite banking concept, what it is. If there's any questions, feel free to ask me. The best way to get a hold of me is design your future. Well, design an even better future.com. You can set up a quick conversation with myself, or simply send an email, and I'll be happy to answer any questions that you have. Another great resource is the ibcanadagroup.ca. They are the independent, acknowledged infinite banking practitioners across this great nation. Has lots of awesome stuff on that website, and you can have an advisor that is close to you help you out with this concept if this is something that you want to go even further into. All right. I hope I answered all your questions. Until next time, until next Monday, be healthy, be wealthy, be wise, push through the noise. All the best.